Do you traditionally ask the first question, or do you have like, one of those things where, somebody else is supposed to do that?
Yeah, I usually just bring us in. So it's and trust me, we keep it real short. And we're
No,
live.
it's all good. You can go as long as you want.
Awesome. All right, we're live. Welcome everybody.
We
We are
are.
in Business Spotlight number 9. We're almost in double digits. I'm so excited. So
I was hoping to be 10.
we can do maybe when we hit like 100, you could be our first triple digit.
All right, that sounds like a plan.
We're going to be doing that in the next. We're going to up it to maybe 2 a week, right?
Oh,
Does that
all
sound
right.
exciting?
So-
Leah's like,
Yeah.
Anyway, so welcome everybody. Today we have Rick. I'm going to make sure I say this right. De Oliveira.
Oh boy, you're trying your Brazilian on me. De Oliveira. It was very
De
good.
Oliveira. I used to actually date a girl with a very similar last name. That's why I went for it.
There you go.
And you were with Olivetree Financial Coaching,
Yes.
and I guess let's just jump right into it. Can you give me an idea of? I just finished reading your website and all of it. Just tell me a little about you, and then what your business is.
Sure. So I worked for corporate America for a long period of time. I was in employee benefits. I rose to run a big $6 billion 401k plan, $4 billion cash balance plan for a pension plan. And I just decided that I was going to leave corporate America, and I retired in the middle of COVID. So I couldn't do all the things that I wanted to do, all the traveling that I wanted to do. And I thought, you know what, it'd be really good if I could translate some of the things that I know how to do into a business where I help people make better financial decisions, right? So that's what Olivetree Financial Coaching is about. It's to really help people make decisions on the financial space that are better for their long-term view, right? And that's why I set up the business the way I set up, in that I'm a sole practitioner. You talking to us, you talking to me. And you get the idea of the philosophy that we use is to get your financial plan in shape. And the idea is that a financial plan should be sustainable, holistic, aligned with your values, personalized, and effective, right? So once we get your financial plan in shape, then it's like almost like self-maintained, which is the beauty of it is I coach people to get them to a spot in which they may not need to talk to me for months. And that's the ideal scenario. I don't want to be constantly selling something. I don't sell anything, right? So I just want to coach people to make better financial decisions and get their plan in shape.
Awesome. So I'm gathering, I guess, based on just how you explained that. So number one, it's very cool that you have a system and an acronym, and like you're very clear on your values. Is it like all like one-on-one conversations, and then is it like per conversation how the fee structure works? Or
so first of all, I do one-on-one conversations or one-on couple conversations, right? So if you're talking about people that are married, I'll talk to both of them at the same time. There's a bit of, it's not all conversation. So there is a bit of conversation, and my first conversation with anybody is always free. I mean, you want to talk to me, talk to me. It's like, hey, it's all good. And then I have a mentor that actually said, I only start charging when I start putting pen to paper, when I start writing stuff, which I think is kind of a nice place to be in terms of, now my free structure is either an hourly rate or a set fee that we negotiate in advance. And that's, whatever that works to be. And the way that I prefer to think of it is it's more of multiple interactions. One of the things that is difficult in this space is that I need a lot of data to be able to give you some coaching. I need to get some information from you. And once I get some information from you, I need to kind of crunch that data. And then I need to present that data back to you in a way that actually makes sense, right? So most of us are not thinking holistically about all of our financial plans, right? We know we have a 401k plan over here, and maybe we have, maybe we have a HELOC over there, and maybe we have, a house that we rent out. But we don't look at it holistically. And what I try to do is to kind of make people look at it holistically. And then I present it back to them. And it's actually kind of interesting because one of the things that I find is that most people don't know how much money they have. They don't know how much they have in assets and how much they have in liabilities. So part of what I find in that you asked me about, I know you asked me about coaching structure, coaching fees, and I'm talking more about coaching structure. Right. So I really do talk about people making sure that they understand where they are, because I think that it's very difficult as a coach to help people go somewhere if they don't know where they currently are. Does that make sense?
Mm-hmm.
It
Yep.
does. They have this bold law. We have this coaching class at KW, and uh, they say prescription without diagnosis is malpractice. So,
It is. It is true.
and with this, like what you're talking about, I kind of have similar conversations with my coach. Like it takes a while to, like, we review our my net worth every month and all that. Like you have to know where you're at before you can figure out.
Right.
And it sounds really simple, but it's really not all that simple.
No, it is. It isn't that simple, because most of us have very structured but separate financial lives. So I'm going to be stereotypical now and talk about, let's say, a couple with 2 kids, right?
Yeah.
So you may have a 529 plan for those kids. You may have a spouse that has a 401k plan in one firm. They have a spouse that has a 403b in another institution. They may have 2 401k plans that they haven't done anything with from previous employers, right? So all of that is kind of disjointed. And it really does help to think in terms of things being holistic and being one, right? And that's the place that I go. And then the place that we go from there is to take it apart. Because the beauty of being separate and having it is that you can start thinking about, and I try to avoid jargon. So if I start using jargon, you can slap me, right? You can do the slap face thing. So I know that but what I try to do is to make sure that people understand that you don't have to, let's say you're going to have a portfolio that's 60% stock, 40% bonds, right? It doesn't mean that every point that you have should be 60-40. What it means is that the money that you're going to use last, so let's say you have an old 401k plan that you don't intend to touch for a while, that plan ought to be very heavily stocked, very heavy risk, because you don't need it for 30, 40 years. Money that you're going to need sooner may need to be more heavily to something that has less risk, right? So the downside of having money in multiple places is that you have this disjointed financial life, which I try to bring it together. The upside of having money in many places is that then you can say, I'm going to use this account for this, and I'm going to use that account for this. And you can start allocating assets to those accordingly.
Can I question? Thank you, Brad.
Yeah.
So the difference is, so people have money managers, in larger, if they have a larger account, you may have a money manager, right? Or you have
financial advisor or financial planner.
Right.
Yeah. Mm-hmm.
So you kind of, what you're saying is you're kind of working alongside them in a way. You're like a step above. You're not actually investing the funds.
Yes. So you're sorry, I interrupted you. I apologize.
I'm just trying to understand just so anybody understands, you're different from a financial advisor in that.
Mm-hmm. So your question has multiple layers on it,
okay.
And hopefully I'll hit them all, right?
Okay.
So you're absolutely right. I never take on assets under management. So a lot of financial advisors, they work for Ameriprise, they work for Charles Schwab, they work for somebody else, they may work for Vanguard. They will take your money in and they will allocate that money. I don't take any money in. Those financial planners usually work on a fee structure of assets under management. They charge you 1% or 7/10 or whatever it may be. I actually told I don't do that. So that's not my bailiwick. That's not what I want to do. But what I do is, if you have a financial planner, I will give you what I call a second opinion. It's really a first opinion, but it's a second opinion on how does the work that the financial planner is doing fit into the entirety of your financial portfolio. Right. So both of you guys are in real estate, right? So I'm going to figure that out. So you may be telling folks that, buy a second home and rent it out. Both of you may do that as well, right? So your financial planner may know that conceptually, but they may not have taken into account of what does that mean in terms of what they should invest your money in that way. Mm-hmm. Or you may work for, not the two of you guys, but you may work for a company that, or your spouse may work for for the city, or may work for a place that has a pension plan. So if that actually still exists, there's not too many, but if you have a pension plan, then you should think about your investment differently, right? Because you can afford to be more aggressive with that bid, right? So what I try to do is to take a look at what you have everywhere, not just in one bucket, and make sure that they are working together. So you said your question, I told you your question had a lot of layers, because your question talked about my business model of taking assets or not, and I don't, right? You talked about whether or not I work with financial planners. Sure, I have no problem with them. They serve a role. Some of them are good, some of them are bad. It's like real estate agents, right?
Yeah.
Right. So,
Yep.
and I can give an unvarnished opinion of what that's going on. And the third bit is that I don't have any products to sell, right? So if you are an Ameriprise guy, and I don't mean to pick on them, or a Schwab, or whomever, or Fidelity, and I should just give them all the names so that they don't sue me.
Somebody takes offense.
So if you work for any of those houses, they have their own products. And you know what? You may have somebody that's saying, well, and I know both of them offer. Fidelity offers an S&P 500 fund. Vanguard offers an S&P 500 fund. Schwab offers an S&P 500 fund. Right? If you work for Schwab, which one are you going to recommend? Right? If you work for Vanguard, which one are you going to recommend? Right? It doesn't matter. Right? So I don't work for any of them, so I can talk about that. I can really do that. I don't sell insurance, but I'll review your insurance coverage. Right? I don't sell annuities, but I'll discuss whether annuities are better for you. So that's the piece where I'm different, Stephanie, from a financial code, from a financial planner or a financial advisor, that I'm not selling you anything. I'm not taking your assets under management. I'm just coaching you on what you should be doing with the money that you have.
Right. Yeah.
Yeah, it seems like it's a lot easier to have your incentives be more aligned if you don't have your own products to sell or your own plans to recommend. And it sounds like, and like you said, like when someone has assets under management, like those 1% fees, even if your portfolio does go up over time, like when you compound that eats up a ton of your profit at the end of the day, right?
Can
I
hire you?
Just throwing it out there, I feel like it can often compound that over 20 years, and if you're going up 3 but losing 1, like you could lose whatever. So is the goal, like, or what's your average, I guess, I know you've been, because it's been about a year, you started your own personal.
I just started my own business, launched it as an independent business in May.
Okay. So
I have been doing this informally for 3-4 years, as we call it the side gig. It wasn't a side gig. I've been doing this informally for 3 or 4 years.
Gotcha. So does your average client, like, I guess you could end up having a business relationship with someone for quite a long time if things are going well, and you watch them as their portfolio evolves and they're adjusting risk here and there. Like, that's the general plan? Or
so do you mind if I go a little hard ass on you?
Sure.
All right.
So I think that what changes more throughout a person's life is not necessarily their portfolio, is where they are in their stages, right? So if you are 25 years old, you graduated college 3 years ago, you have $80,000 worth of student loan debt, you are not in a relationship, and you have a company 401k plan, right? If I'm going to be working with that person, I'm going to be working on that person on how to make sure they keep their retirement savings on track, but also how to get a debt down, or how to save money for a house, or how to get that piece forward. So we tend to, and this is because that's where they make money, we tend to focus on the allocation of assets, but there is a lot of work that needs to be done, not on the allocation of assets, but really on how you should structure your financial life. Does that make sense? And I'll just touch on insurance for a little bit, right? So full confession, I'm married, no kids. We have no life insurance, neither my wife or I. Why is that? Because as heartbreaking as it would be, it doesn't make a financial impact in our lives anymore. You take the, no, going back to the stereotypical, no, kids, spouse, house. You need some life insurance, bud. Right? Go back to our 25-year-old that has college debt. Not really. Right? So basically, where you came to me and asked me a question around following people's portfolio throughout their life. And I think it's more about following people's life throughout their life.
Gotcha.
Right? Does that make sense?
It does. Yeah.
So one of my questions was going to be, you can work with, and maybe you don't, I don't know, but you could work with, people of all ages, but what you'll be doing for them is something different. Like younger people just starting off, you're going to try to help them to build up a portfolio.
Right.
Whereas if you're older and you have your assets in different places, you're going to help bring it together, get it more organized, and help it flourish even more than it has been. And your conversations may not be as, it may be more, sorry, you may not have as many conversations as long term, because.
So Stephanie, if I may, let me take you where you talked about really and kind of break it down. And I'm going to use a little bit of jargon and then I'll back off, right? So the younger person, you're talking about, how do you accumulate assets?
Right.
What's the best way to actually build a portfolio that when it gets point for them to send the kids to college, when it gets point for them to buy a house, when it gets point to them to retire, how do we do that? How do we have the assets put away for that, right? So that's the accumulation phase. At some point, you get to the point where you have assets. You have your house, maybe paid for even. You have a retirement plan, or maybe you have 5 401k plans. And now you have to turn assets into income flow, right? So I basically meet people where they are. And I will advise them based on their situation in life, or coach them based on their situation in life, because I think that that's more important than having a cookie cutter portfolio and saying this is the portfolio that you need at age whatever, right? It's really more about figuring out what is it that people are trying to achieve, and then aligning what is it that they're doing with those. Does that answer your question?
Yeah. I assume that you could work with people of all ages, because anybody could use help in some manner. But I feel like a lot of, especially people who don't have income, or don't have a lot of
savings,
a lot of assets, they may be, afraid to come to speak to somebody like you to figure out how to build up.
And you know what? That's a shame, because I think there is that perception out there, and a lot of the folks that you were talking about earlier, the financial advisors, will require minimums of like $250,000 to invest with them before they even talk to you. I don't have a minimum, right? it's like that's not going to be an issue. And perhaps more importantly, if you're not going to figure out what good money habits are, if you don't have a sustainable plan, if you don't have a plan that is in shape, you're not going to accumulate that $250,000 in assets, right? So the idea is, how do we build for a person, any person, a plan that is sustainable for life, right? And takes into account everything else, so it's holistic. So that piece of how do we do that is the piece that like intrigues me and gets me fired up. Okay. And now, if you have no assets, that is perfectly okay. If you have no assets and you're 65, that's a problem, right? If you have no assets and you're 25, that's better than I was. I think I had debt at 25, you know what I mean? So that, I think, is the piece of where we need to meet people where they are. I like to meet people where they are, and I like to help people move along the curve. And that curve is more than, oh, I don't have any money to invest with you. It's like, you can't. I don't take any assets under management. You don't invest with me. I really try to help you free up money. So I'll give you one example, and I think it'll be general enough that it actually merges a couple of specific people. I talked to 2 different clients this week, and my only advice, and I got zero money for this, I didn't get paid for either one of these, is go refinance your mortgage. Right? They both had mortgages. You guys are both in real estate. They both had mortgages that they've taken out like 6 years ago at 4%. It's like, before you talk to me, right, before you even do this, get yourself on a 3% 20-year, or something like that, which I think is what's available now.
Yeah.
then that's going to free up a couple $100 a month for you. Once you free up that couple $100, then let's talk. All right. But it's the kind of thing that meeting people where they are is so significant for me, and really helping them identify how they can actually generate assets, generate income, so that they can actually invest.
Awesome. Yeah, it's a good piece of advice, because we've both seen tons of people, I mean, who refinanced recently, and just for this, like you said, like they bought less than 10 years ago, and getting a 20-year mortgage at a way lower rate just all magically saves them just like that. So
Yeah.
I have sort of a loaded question.
At least you warned me in advance. I know it's coming.
Yeah, like I'm curious to hear a little bit about like your past in managing a much larger amount of assets, like or 401k plan for the company. Like, how does that? This is very general, right? But like, if you're managing? It was $6 billion. $6
billion. Yeah.
Managing $6 billion, right? And I'm
Well,
sure you have a whole spectrum of investment that goes in, because it's a lot of people's retirement funds in one, if I'm understanding it right?
Mm-hmm.
Like, what kind of investments, or like what does a day-to-day like in that kind of business look like versus, like the average person? Like I've never spoken to someone probably directly who's been in that type of position.
So I'll do the self-deprecating part first, because that's a little more fun. Nobody takes my phone calls anymore. When I call one of the money managers now, I talk to their call center and not to some people that are interested in our business. No, but seriously, the basics of it. So let's be clear about what I did and what I didn't do, just to because I like that clarity. We had a 401k plan that has $6 billion in assets, and I was responsible for choosing which funds were available to employees in that plan. Employees determine how to invest that. Okay. And then we had a $4 billion fund that was a pension plan fund that the company itself invested, and I was part of the people that chose what those investments are. Obviously, there are certain things that if you're investing that kind of money, especially on the pension side, that you can take a different perspective on, right? So we can buy whole buildings, right? So you can buy real estate, but instead of buying REITs, you actually buy specific units. So you can do something like that, and that you can't do as an individual. You also can negotiate much lower fees. So every fund out there has an expense ratio. So if you have this kind of money on there, you can get some really good expense ratios for your participants and for the company as well. So that. So
the expense ratio, what exactly does that mean in this?
Yeah, okay. So if you go to any fund whatsoever, any mutual fund whatsoever, the mutual fund is going to have a cost associated with the running of the mutual fund. So let's just say that the underlying investments return 7%, and the cost of the mutual fund is 1%, right? So the net that you get would be 6. And by the way, that expense ratio is different than, I use the same 1%, I shouldn't, than the fee that a financial advisor would charge. The financial advisor charges that fee, and there is an expense ratio in the fund.
Okay.
And every fund has it. They vary, but no, every fund has an expense ratio. Fidelity has a promotion with their S&P 500 now that it's 0, so they don't charge. But I haven't looked at what they'd have, like account fees or anything like that. But every fund does have an expense ratio, and they have to disclose it. I'm sure you've heard the term prospectus. The prospectus disclosed the expense ratio usually around page 18, maybe page 26. Right. But if you just go to something like Yahoo Finance or Google Finance, they'll have it right up front.
Gotcha. Huh. All right. So so it's pretty much a different. So you're probably looking at all sorts of different investments, including like larger pieces of real estate and larger funds and all that.
Yeah.
That type of portfolio.
Indeed.
What was the most, I guess, like what was the what would you say is like the most interesting or coolest part about doing that?
So this is why I think I'm going to be this is why I think this is a good stuff for me to be in. I'm going to give you a quiz. I'm going to turn the tables and throw a question at you. What do you think was the best indicator of which 401k fund was going to get money in let's say Q2 2022?
When you say get money in,
You mean employees saying, oh, I want to invest in this?
the return on,
The return on Q1 2022. So you win the prize, right?
yeah,
So what people really do is like, oh, this fund has been doing really well. Let me put money into it,
got it.
right? Now that is not exactly long sustainable approach because you're buying when the return already happened. No, unfortunately, we can't have a crystal ball and see what the return is going to be. So the thing that was most fascinating to me was to watch participants' behavior and to see that participant money flow tends to be heaviest into the funds that just did well. So that was, I think, the most interesting thing about it.
Yeah, it seems like it could, especially like say right in today, the climate like today, like a lot of people could end up getting caught like that. If you're looking at, oh, this is the return, oh my God, and then all of a sudden we're about to take a nosedive. Like who knows if it's a nosedive or a slow, whatever. But
Yeah.
a lot of people could get hurt. So that's all right. That's interesting. I guess it makes a lot of sense. It's kind of like human nature.
It is human nature, and part of what I talk about in terms of helping people make better financial decisions, it's to really try to figure out when are those key decision points, and can I help you make a better decision than what human nature would let you to believe, right? So that is kind of the piece that I think is part there.
Very cool. All right. So if someone were to like, let's say someone's watching this, like, all right, cool, I'm game. I need help. Like, what's the next step?
Well, so the first step is always to talk, right? I don't know how to help you if I don't know what we want to do, right? So I would set up an appointment with them. We would spend, and I've done appointments that were as short as 30 minutes, as long as about an hour and a half. And we would talk. And frankly, it's more my listening and asking questions than it is my speaking, right? I've been accused or it's been pointed out to me that I give way too much free advice on that session because it's just how I am in terms I start thinking about what they should be doing, what people should be doing. And then we start with what kind of engagement do they want, right? So I'm working with a client now that basically just wants me to set up what their next, let's say 4 years, they're about to retire, they're thinking about retiring later this year. What are the next 4 years cash flow look like, right? Because they are, I don't know, close enough to thinking about when they should collect Social Security, when they should start tapping their 401k plan. So how do we plan those 4 years, right? So that's a very different engagement than someone else that I'm working with now that really is really thinking about ramping up their savings for retirement. They just got a nice promotion. They're working for a nice company. So they're in a different spot, right? So since they're in a different spot, they're going to get different advice. So the first step for anyone is let's have a chat. I'm going to be doing a lot of questioning and listening. And then I'll propose a scope. And the way I work with this is I go to folks and say, hey, based on what you said, this is what I think you need. And then I'll tell them, like, and I charge, and this is my max. So if I spend more time than I thought, then this is how much you pay. If I spend less time than that, you win. So that's kind of how I work. We set up the scope. And the thing that's interesting is I do have a boilerplate contract, but the scope is unique for each individual, right? Because I meet people where they are. So depending on what kind of work they want to do, that's how I would go about it.
Awesome.
Yeah.
Makes a lot of sense. And where do people contact you?
So my website is Olivetree FC. So Olivetree, the letter F, the letter C.com. And in there is a email me or email us button and send me a note. And we can start the conversation.
Perfect.
Wonderful.
Did you have any more questions, Steph?
No, not right now. No.
And I don't know if I succeeded in getting Leah to think of a question she should ask.
Did you? Yes, one.
Oh, I actually put on social media, because something that intrigued me about your website was the tab that said your mom. I actually didn't read the whole blurb because I wanted to hear from you and have you tell all of us how your mom inspired you to start.
All right. So Rodney, do I have time for that? Because I know our 30 minutes.
Sure.
I did read that, and I'm curious to hear about that too.
So here's how it happened. So mom is badass. Or I can use that word in Facebook Live, right? Yeah. And she it's probably about 5 or 6 years ago, I forget the exact time frame, maybe a little longer, lost her second husband. And she was devastated and all of that stuff. And we tried to do all the support that we could. And she specifically asked me can you take a look to see what her finances were and how she was doing that? So I said, sure. I took a deep breath. I was already working for the 401k plan. I was already working in benefits. And I was like, okay, I got to deal with my mom's finances. That's heavy stuff, right? So mom had a financial planner. And what I found is that planner had put my 75-year-old mother, who had at that time had enough assets to basically draw down for the rest of her life. That financial planner had my mother invested in 29 or 27, I forget the exact number, different funds, including a German real estate trust that invested in euros. And I just couldn't understand how that made sense. I just couldn't, right? So I started digging because I was trying to figure out why. And no, this is why, Leah, this is actually what prompted me. It's like, I found out that those fees were pretty heavy on that fund. And I'm sure some of them actually, well, I'm not sure. I'm not saying that it happened, but it's possible that some of those fees kind of made their way back to the planner in some way. But what I did find is that she was being sold, you need these many assets for diversification. In reality, she didn't have that much diversification. There was concentration in different places. And I was like, you know what? That sounds like what every single son would do. I went back to school. I got a master's in financial services. I took all the courses that I needed to pass a CFP exam. I passed the CFP exam, and I decided to launch my own firm. So that's how my mom is tied up, Leah. What do you say?
Cool. That's a great.
When you first sent over the information and the graphics, I saw the picture of your mom. I didn't know if you accidentally sent us your whole all the pictures you have in your phone.
No. That was intentional. That was definitely intentional. And the thing.
You can find that picture on the website. Don't worry.
Yeah,
it's there. It's there. And the thing that's fascinating is now my mom is in, I kid you not, I think 5 funds. She's just as diversified. She has a much higher percentage of her assets in cash and cash-like equivalents. Yeah, I know it's not paying any interest, but guess what? She doesn't need it, right? She has some money in stocks. Those stocks are longevity insurance because she has good genes and she's going to live until she's 100, right? So I think it's much more appropriate for somebody of her age and risk tolerance than what it was. But yes, so that's where my mom ties in. She's she inspired me to kind of actually go back to school and really kind of get into it beyond what I was doing with the company's 401k and the benefit plans.
That's a great story because I wouldn't have guessed when I was reading you going. It mentioned you going to school. I had assumed that you went to school like way back when, not that that inspired you to go to school, which is very cool.
So I have so now you ask me about my background, I'm going to tell you. I have a degree in economics back from the 80s.
Yeah.
I have an MBA back from the 90s. And I have an MS in financial services from 2017. So I was frequently the oldest person in the classroom, even older than the teachers, right? Yeah, group projects were very interesting. I can tell you that.
That's awesome.
I can only imagine. That's great.
Cool.
That's awesome.
You guys have any other questions? Any other fun stuff?
I have a ton of questions, but we would be here for another like 2 hours. It really would be.
You know what, Rodney, if you just want to chat with me, I told the people the first conversation is always free. So,
Appreciate that. Maybe setting one up.
all right. Sounds good. Sounds like a
Cool.
plan.
Excellent.
You want
All
to take it out, Steph?
Yeah, Rick, thank you so much for coming. It was a pleasure. Pleasure to see you. Loved hearing about everything that you're doing. It's exciting.
All right. Thanks, Stephanie. I
I'll be
appreciate it. It's been
calling.
a fun-
Thank you.
All right, sounds good. All right. Sounds
Awesome.
good. Thanks.
Take
All right.
care. Thanks.
Bye.
Talk to you later. Bye.
Bye.